The new book, Land to Lots, written by Carter Froelich, is now available to purchase on Amazon. Get your copy of Land to Lots, How to Borrow Money You Don't Have to Pay Back, and launch master planned communities today. Welcome to the Land to Lots podcast, powered by Launch Development Finance Advisors. And now your host, Carter Froelich.
Welcome, everybody, to the Land to Lots podcast. My name is Carter Froelich, and it's great to be before you here today. Before we get started, we're going to get into a little bit of housekeeping items. I will be covering a lot of points today, and so what I've done is I've prepared an outline and attached the outline to the podcast show notes. You may want to print out the outline prior to listening and continuing with the podcast so you can follow along. Or alternatively, when you're done with the podcast, print it out, put it in your files for a reference piece of material. As it relates to large-scale master plan development communities or residential communities, whatever type of project that you have, it is really important, whether economic times are good or whether economic times are bad, that we're continually going through our pro formas, our development agreements, our line extension agreements, and doing everything we can at every point that we can to enhance our entitlements. And to do this, what we typically do when we're looking at a project is something that we call a project diagnostic review. This can be done whether we're just kicking off a project, just starting it, or it could be done anytime during the development of this project. Most of the times where we see this being done is when the economy turns and starts to trend downward. At that time, most of our developer clients tend to get religion and start digging into their agreements to see what they can do to enhance project revenues and reduce costs. But in essence, that's what the project diagnostic is all about. It's a formalized method of going through and reviewing a development project to determine that we are maximizing all of those revenues that we have available to us, or more importantly, could have available to us, and that we're doing everything possible, depending upon where we're at in the economic climate, to reduce, eliminate, and defer costs. So, how do we begin the project diagnostic? Well, assuming we're starting with a project that may just be in its early stages or just kicking off, the first thing that we do is sit down with our developer clients with a land use plan, their pro forma, and their construction cost budgets. Prior to us coming to the meeting, we typically like to go through any entitlement documents they may have, whether those are actually executed or they may be in draft form. So this would be most of the time we're talking about a development agreement. So the first document that we're going to be looking at and going over with our client is the land use plan. We want to understand where the project is located, where the utilities are coming from, what is the developer's anticipated phasing schedule, what are the lot mixes, amenity package, who will be owning the open space, the trails, the parks, are they HOA, are they public parks, are there any drainage facilities, are there lakes, who will be owning and maintaining those? Has the jurisdiction required the developer to fund certain infrastructure requirements that may be in excess of what the project's needs may be? In other words, are they looking for oversized infrastructure? So that's kind of a background information. We're getting a feel for what this project is, where it's located, and what we need to do to develop it. Based on our review of the development agreement, assuming that there is one, or conditions of approval, depending upon where we're working in the United States, What I'm looking for in the development agreement primarily relates to infrastructure requirements and timing, meaning what has this jurisdiction conditioned us to build? Are we having to build 4-lane highways day one, or do we have the ability to build those roadways, those arterials and collectors in a phased manner? Meaning, can we build 2 lanes at the beginning of the project and at some point in time add the other 2 lanes? So what are those requirements, and what are our possibilities of being able to push some of those costs further out into the pro forma? Does the development agreement allow us the use of special purpose taxing districts? If so, what does that language look like? Is it favorable for the developer, or is it very limiting for the developer? We like always to be able to get in and make sure that we're adding very favorable financing language to the development agreement to create certainty on the part of the developer, so that they know that when it comes time to issue bonds to either construct infrastructure or reimburse themselves for that infrastructure, that they know it'll happen. And this is where we see this to be a really, really important factor, is in districts that are controlled by jurisdictions, meaning the developer and or developer related entities, if I can use that term, are not in control of the district. And given the shift in political climates, whether those be anti-developer or anti-growth, and all of a sudden the city council says, you know what, guys, we're not going to issue any more bonds for you, we're done. That obviously can really jeopardize the financial results of a master plan community or large residential project. So we want to make sure that we're creating certainty on the part of the developers related to that special district. Also, we want to make sure that they have a lot of flexibility, meaning, does the development agreement and the authorizations to use special district financing allow us to finance basically everything allowed by law, or is it a very limited list? Obviously, we want a very sweeping list of infrastructure and costs that we can reimburse ourselves over time as we develop the project. What other types of reimbursement or infrastructure financing mechanisms may be involved in the development agreement? So we're looking for, do we have the ability to collect sales tax increment? Do we have the ability to get property tax increment? Do we have the ability to be reimbursed through impact fees? Is a lot of the infrastructure that we discussed or read about in the development agreement, is that infrastructure that is the like type and kind for which the jurisdiction is collecting an impact fee? Could there be the possibility of receiving impact fee credits? Does the agreement allow us to set up reimbursement agreements with other benefiting landowners? And here again, that's why that land use review is so important. When we're looking at the land use plan, I'm looking at, is this infrastructure that we are going to be building benefiting other landowners? If it is, I want to have conversations with the jurisdiction to see if we can tag those other benefiting landowners so that they're paying for that infrastructure sooner rather than later. In some instances, we can even bring benefiting landowners kicking and screaming into districts where we can get to where we have the ability to lien their land to allow them to pay for their fair share of that infrastructure sooner in the pro forma rather than later. Here again, it's more of a situational by situational analysis, and also what is the political climate with the jurisdiction. In relation to development impact fees, the language that I'm looking for is, does the development agreement go through and outline the means by which development impact fee credits will be calculated, or how those development impact fees will be coming back in to the pro forma Are they coming in quarterly? Are they coming in yearly? Are they coming in every 6 months? How are they being calculated? Is it the lesser of what's in the fee study, or is it actual costs? These are all a lot of detail, but we're really trying to get a feel for what's included in that development agreement. The other thing we want to look at is how is oversizing of infrastructure handled? How are the oversizing costs determined? And how are those allocated to the other benefiting landowners? Do we have the ability to collect interest on the funds that we will be advancing for the benefit of some of these other benefiting landowners and or the city? Additionally, does the jurisdiction through the development agreement require us to fund what they perceive as potential operational shortfalls? So, for instance, if we need to build a fire station and they say, hey guys, this fire station is going to cost $1 million a year to run, we want you to pay for the operational shortfalls for the next 5 years to offset this $1 million cost. Yeah. How did they come up with that number? Is there a number? We're going to want to know that information up front. We're going to want to make sure it's in our pro forma and our cash flow. But more importantly, we're going to want to go check those numbers, and we're going to get into that in just a minute. So those are some of the big picture items that we're looking for when we're going through the development agreement. And here again, we're going to do our homework before we come in and start talking to our clients related to the land use plan. Next item is the job cost reports. So, Mr. and Mrs. Developer, you've got this project, you've got a development agreement, you've gone through, you've got rough cost estimates. What are those cost estimates? And how do these cost estimates line up to your land use plan? I literally want to take items line by line off of your job cost and put them on the map saying, okay, this is this roadway cost, this is the wastewater treatment plant, this is Park A's cost, this is Park B's cost, etc. Really want to try to get an understanding of what those costs are and how they fit into the puzzle piece of the master plan community and the phasing schedule of the development of the project. Then, with all of that information, we're going to take a look at your project pro forma and go through line by line and go through your supporting schedules. Hopefully, you have supporting schedule and all of the detail. I've seen some really good pro formas. I've seen some really bad ones. But what we want to do is go through and based on our understanding of your master plan community, your lot mixes, your phasing, your development agreement, your job cost, are those facts properly reflected in the pro forma? For instance, we've seen some pro formas where a developer or their analyst has chunked out the development of a wastewater treatment plant on phases. The problem is that the development agreement requires that the wastewater treatment plant be funded 100% day one, but yet they were showing it in the pro forma as being phased over time, something that was impossible just given the construction of the wastewater treatment plant. So these are some of the things we're going to start looking for and why we want to take a look at your pro forma. So with that as background information, let's jump into what we're going to be doing to see if we can't make sure that we're maximizing your revenues and reducing, eliminating, or deferring your costs. So how do we do this? Well, the first thing we're going to do is we're going to take a look at your top line projections, meaning, are you selling finished lots? Are you selling super pads? What is your lot segmentation and product pricing? So we're going to take that. We may even take that back, and if you allow us to run it by some of our sister companies, which are the land advisor organizations, brokers. And because they're in the market dealing with builders day in, day out, they have a real good feel for what are the builders looking for. Obviously, that's dictated by cost, but it's also dictated by the market. And if the builders are looking at 45-foot lots and we have 80-foot lots, well, that's a problem, So we may want to take a look at further refining our lot mixes, assuming that we have the ability to do that and we have the ability to do it in our mapping to make sure that we are putting forth, as we develop the project, the best mix of lots possible given the demands of the market, which we as land developers, we're looking towards the home builders, and the home builders are obviously paying attention to what the home buying public is requesting. The goal of this is to determine the reasonableness of our assumptions. We don't want to play games at this stage. I mean, these are our numbers, and we have to make sure that we're being realistic when we are projecting both our sales prices of our lots and the pace of those lot sales. Having other disciplines involved, meaning land advisors, their brokers, could be market consultants, etc. Looking at our numbers, it just gives us more information to make better projections as we're preparing our top line revenue estimates. The other thing we want to go in and take a look at, have we thought about all of the potential revenue sources? So obviously we're selling lots, but do we have the opportunity, and have we really thought about view premiums that we may be able to be capturing? And if so, have we walked the lots? Have we determined what each one of those lots view premiums may be, whether it's got a vista or it's on an open space or a trail or on a golf course? Have we thoroughly gone through, and are we continually to thoroughly going through to make sure that we're maximizing those revenue opportunities? Also, as it relates to the deals that we're cutting with our builders, are we also asking for private, for lack of a better term, impact fees for water, sewer? Do we have the opportunity to do that? Should we be thinking about that? Are we charging them an amenity fee, a park fee? What are the builders contributing towards marketing fees? These are all things that we want to make sure that we have a really good pulse on the market, and that we are making sure that the builders are helping to contribute to the success of the project by offsetting some of these costs, but also to help provide funding for a robust marketing campaign, which will not only help them, but will also help us as we move forward in the development and build out of this project. So that's really kind of the top line revenue review we go through. We get into other things as well, but those are some of the main components. Well, that takes care of our first installment of the Project Diagnostic series. We'd like you to tune in on Wednesday for the second installment on the Project Diagnostic series.
You have been listening to the Land to Lots podcast with Carter Froelich. Follow us wherever you find your podcasts to never miss a new episode.